we delivered reasonably stable and consistent results again for the period. So for the full year, FY18, we had 8.7% growth in revenue, 4.5% growth in costs. So we've done a good job again this period in maintaining our costs and continue to have discipline in that regard, continue to invest in things that provide us with sustainable growth over time, but again, delivering margin improvement through the cost control, which gave us EBITDA growth of just over 10%. So the results were fairly boring, which was good. Going across each of the markets, Melbourne had reasonably low levels of growth. That's largely because of the CityLink widening project still going on during the period. It did finish around the middle of the financial year, so at the end of December, and we've seen some good pickup, particularly in the last quarter. And we also noted that we had really strong truck traffic in Melbourne as well. And we've had a truck toll multiplier going through during the period, which meant we had very strong revenue growth coming through in Melbourne for the full financial year. I'll just on that point, we also had truck growth across every single asset. There was one asset, the go-between bridge in Brisbane, which the folks in Brisbane would know doesn't really have any truck traffic. So if you put that aside, every one of our assets had truck growth exceeding car growth during the period, which may be a bit of a leading indicator for you. In Sydney, again, very stable growth in both traffic and revenue, so not much to talk about in Sydney. In Brisbane, we had good traffic growth. Our revenue growth was a little bit pulled back because we have done a lot around our fee structures in Brisbane, also across Melbourne and Sydney as well, but our fee structures in Brisbane, where we've been reducing our fees for our customers, which again is great for our customers and an investment in the longer term for us, but we did see our revenue growth being a little bit below where we'd normally expect them to be in Brisbane. And the US, again, continuing good growth there, albeit we came off incredibly strong comps the previous period, where there was some rail track works that effectively meant we had a lot of vehicle traffic on our assets for particularly that last quarter last year. But backing that out again, we had very solid growth across the US, which was great. We continue to deliver on our development pipeline, so we've still got that $10 billion development pipeline and opportunities in each of our markets. The CityLink widening, as I said, has finished during the period. We're still progressing the Logan Enhancement Project and ICB, both of which will be wrapping up over the coming months, as well as the Gateway Upgrade North. So Brisbane's about to come into a period with much lower disruption, which will be great. And the talk of the town at the moment is around WestConnex, so no doubt Nathan and others may ask me a few questions that I can't answer there on WestConnex, but we'll talk about that in a moment, where we're in the middle of a bid process and there's a few interesting things around the ACCC going on in that regard. And the Westgate Tunnel project, again, here in Melbourne is progressing really well, and there's been quite a few changes from a political perspective through the political lenses since I saw you last time, and that's all progressing well now, which is good. The other thing to talk about is around the balance sheet. So again, if you look at the balance sheet for the period, and it's certainly at 30 June, we've extended the average tenor of our debt. We've kept our cost of debt down nice and low, so no changes to our cost of debt. And also just highlighting for the period that for the next 12 months during FY19, we've got about $600 million worth of debt to refinance. Remembering we do normally about $4 to $5 billion a year, so it's a pretty small year in the context of what we have to refinance. And all of that debt that we're refinancing is priced in the high sixes. I can refinance sort of 10-year debt at the moment in the mid to low fives, even high fours. So there's plenty of capacity to be able to refinance our debt and keep our cost of debt low during the period. And then moving through to FY20, a lot of our capital markets debt there as well is priced in those high sixes. So again, got some capacity to be able to hold our cost of debt down fairly low. So the big talk of the town, as Nathan spoke of, was around our distribution guidance. So we maintained a healthy distribution growth of 59 cents for the FY19 period. Consensus was a little bit higher than that, but what we were able to do was come out and say that if we are successful with the WestConnex bid, then we will maintain our distribution at 59 cents.